in the 21st century. Hard-working people working hard for you and me. Moving higher, time and time again. Through the years you'll find us here. Moving higher.
Hello and welcome to Moving Iron Podcast number 196. This week my guest is Rich Posson. Rich is on here quite a bit, and I am real thankful that he's on here. But this edition of the Moving Iron Podcast is brought to you by Dawsontire and Wheel, your premier ag tire and wheel provider in North America, helping people grow. Tractorzoom, delivering insights, and Dryshod Boots, the official work boot of the Moving Iron Podcast. Rich, how you been, man?
Good, Casey. How are you? Not
too bad. So Rich has got a podcast of his own called Critical Point, and you can find out anywhere, right, Rich? You can get out there on iTunes and all that, every place you can find a podcast.
Yeah, and they can look up criticalpoint.podbean.com. That's a website that the Podmaster set up for me. And you can see a whole list of the latest podcasts and sign up for it there. And while we're on the subject of podcasts, I'd like to announce this week I'm launching a new podcast that's meant for the long-term stock investor. It was by request. Some of my followers, subscribers saying, that I could be missing out of some people that need help with like beginners of how do they invest, how do they work with their retirement account, as well as some professionals that would be interested just in the long term. Whereas in my original podcast here at Critical Point, we do commodities and stock market, and in very detail, like practically every day, we got something to say and all kinds of signals. So I've launched a new channel. It's can be purchased at 1 quarter at a time, 3 months at a time, called Seasons. And the name of it is Keeping Up with the Stock Market. It's a soap opera, so we're going to have a little fun there, how that market works.
Yeah.
And I've had a bang out year here in the stock market. I'm up anywhere from 20% to as much as 95% in one of my programs. And most of that was just getting out near the top in February and got in within 2 days of the bottom in March. And it's just been a sweet ride when, man, there's a lot of professionals out there who've had a tough year.
Yeah,
keeping up with us. I'm just very thankful after all these years of how smooth the model ran for stock and commodities this year.
Yeah. That's good, man. That's great news. Looking forward to that content, what that looks like, and folks, check out that Critical Point podcast. I've listened to some of those podcasts that are out there and got some good information, and some of them are, I mean, they're not necessarily that long either, Rich. I mean, some of those are, I've listened to some that are 5 to 7 minutes long, and I've listened to some that are 25 minutes long. So it just kind of depends on the topic.
That's right. Some subscribers, once they have a feel for what I'm doing, modeling, quite often they'll say, give us the bottom line quick and whether we're buying or selling. So.
Right on. That's right. Okay, Rich, let's jump in and talk about some stuff that's going on. So Rich is on here. We're talking economy. We're talking trends that are developing out there. We're looking at foreign markets. We're looking at international grain markets. We're looking at all these different things that are out there. Everything that's kind of has an influence on the U.S. economy. Also, the U.S. economy that has the effect on the rest of the world as well. So, Rich and I were brainstorming a little bit before we got started here as to what we're going to talk about. And of course, Rich has a laundry list of stuff that he wants to talk about, and it's all great stuff. And I don't know where to start. I guess the best place to start, since it's the most recent thing that's out here on people's radar, is that Tuesday USDA report that came out. A lot of good news came out of that. I saw some estimates that were well under, or actually well under the estimates on average bushel per acre on corn. Soybeans kind of stayed about the same, but carryout was way lower, and all the stuff that comes along with all the adjustments in the overall crop size. So I guess, what's your reaction to that report, and what's your reaction to what you're seeing now as far as some USDA balance sheets that you see out there?
Yeah, so it was a bullish report across the board, in my opinion. But the thing is, the market's been rallying since August here for corn, wheat, soybeans, and I just feel like how much more bullish data can it really get? I think it's kind of high priced here. I think a lot of it's dialed in. And you can just see the response in report day. Yeah, it was aggressive. And then, by today, we can just see the market's actually going back down now. So it should have held up better than that because the corn yield came in, 175.8. That was lower than the lowest trade guess I saw, and it was below record. And I was so pleased to see that because, by the way, in early July, I told my subscribers the critical point temperature model says it's too hot, and the forecast for July is going to be too hot. And this crop is going to look wonderful, but the yield isn't going to be there. And then late July, we got another update, and that supported what I was saying. August, everything turned dry, and I said, you know what? Even if the temperature isn't there for us and the model starts backing off, we want to stay with our forecast because we now got this dryness that the model really wasn't watching. And so we had two things going on. And by early September, when I got the official results from the summertime temperature model, it was saying the yield should not be there. And I decided the safest approach to take was it just would not be a record yield. So in early September, I said, I'm betting on it will not be a record yield. And we got it this week. So very pleased at how all the modeling during the year, because even other models that I was using back in January said you should have a strong yield to a record yield. And then those summer models said, back off on that record idea. And the idea was the January model saying a strong yield was that it would at least be a 170. So it's kind of like both models were right because it was above 170 for the one model, and yet it was not quite new record for the other model. So I'm pleased with that, but it's pretty much done deal now. I'm already redoing the models here to be prepared for next year, and I still believe that we're vulnerable for a crop problem in 21 to 24, and I think it's probably sooner rather than later. And we got a La Nina right now, and if La Nina hangs in there the next year, I think we're going to get the crop problem that many of us wanted for some time. And of course, the farmer's been hoping to get some kind of break here and some kind of reason to push prices higher. It may well happen next year, but we got a ways to go on that one.
Right.
Know?
Yep.
And so that then brings me to where we are in the actual S&Ds versus price and what's going on in the world. And a lot of the global markets, I look at Japanese prices, China's prices, India's, Brazil, some of the European prices. And it's like the whole world ran up from August to now. Everybody was on the same page. And it just feels like the world had to get caught up on their pipeline needs, their inventories, get some security in there. And I think they had probably fallen behind the early part of the virus. And I think that made them even more nervous than other times to say, hey, we got to get this inventory built. Well, that bothers me that they might have actually bought ahead here. And so what are we going to get for early next year? So if we don't continue to get really bullish news, keep those exports there, see a problem in Brazil on their crops, I'm concerned that we could be surprised how much demand backs away for a while. And I don't think that means crashing prices by no means. But let's face it, I think it's possible the U.S. corn market, for example, is bullish into next summer seasonally and some of the long-term business cycle research I do. But nothing was in a straight line. And so, there's liable to be some setbacks here. And it could stall out for as much as, 3 months at a time before it moves higher again. So I'm just a little concerned the world's ahead of itself. Tonight I don't like China's corn futures prices. It looks like it's trying to turn down now. Saw some evidence in some European prices for wheat and corn. Soybeans still look strong in China. They look just like a U.S. chart. Brazil prices, corn prices have been extremely strong this year. But in the last few weeks, you're seeing lower highs and lower lows, and that's the definition of a downtrend. Now, it's also a very wide channel. It's very volatile. It's like the market can't make up its mind, but there's an overall bearish bias to it. I think Brazil is probably run higher as high as it's going to go, frankly. But now we'll have to see where we're going with the dryness in Brazil as well, right. And Argentina. La Nina, always had a rule that if La Nina is still present in December, you better get nervous over January through March for Argentina. Brazil's a different story. Certain regions of Brazil can be in trouble, and other regions could crank out a decent crop anyways.
Right.
So that's something to watch going down the road, that if we are going to be more bullish here on these grains in the next year, I think it's going to have to come from a greater problem than what we're seeing right now in Brazil. I'm not so sure the problem is really there. They've had it, but We just need to give it a little more time to see whether it sticks or not. And otherwise, if you don't get that La Nina, it just feels like to me everything's been too bulled up. It's just time to calm these markets down a bit here and set back prices a bit, and granted, my model here for the U.S. tracks 12 major groups of market participants, and it's always dealing with this available demand, available supply that is seldom discussed by anyone. Most people don't even understand it. And it's really what decides where prices are going, not the S&Ds. The S&Ds are more about volume. How much are you actually using? So it gives us a bit of an edge here. And even that model is saying, you know what, the veiled demand is, they're getting to the point where they're going to say, I bought enough for a little while. I need to take a break. And you can bring the entire market down with very little selling if you lose the demand, that's just the bottom line.
Right.
So you can refuse to sell all you want. It can still go down. So, yeah, we do want to be watching out for future crop problems here, but I must say I like the dollar. I'm a long-term bear in the dollar. I think it's going lower. I think it's going to help U.S. exports. So it's not just agriculture. It's going to help our economy. Don't be surprised if you see the dollar tick up a little into December. Don't be surprised if interest rates back off a little bit by December. Bonds go up a little bit, but ultimately further out, I think the 40-year decline in interest rates is over, and they're gonna work higher over the next several years. And unlike some people are on the same page with me, I don't think we're going to see an explosion in interest rates. I don't think we're going to see an explosion in inflation anytime soon. But I do think we're turning the corner, and I think that actually helps commodities for a while. You can get inflation and interest rates too high, and then it does not help commodities, but it can actually hurt commodities as well as the entire economy. Right. But for the moment, I think we're on our way there. I like what I see. So, of course, that now brings us to where are we at with the U.S. economy and global economies, and what about the election? And there's some interesting studies out by others, and I've done studies like this many years ago, and it looked like we're on the same page. Basically, for the U.S. economy, when you take the years that Republicans were pretty much running the show, U.S. GDP ran about 2.5% on average. And if you look at it, before the virus recession, Trump was running about 2.3 to 2.5. So he was doing about average of the Republicans prior. And of course, he was advertising and marketing that he was going to do much better than that, and didn't occur. And I think that probably worked with him against the election. So now on the Democrat side, when they're in power, the GDP ran about 4%. So big difference, actually. And when you get it that high, you usually have better commodity markets. You have a bit more inflation. You help in the middle class and poor more, not so much the rich. And so moving forward, as I look at Biden, I'm saying, okay, I think this supports what I've been saying all along for the economy. And I'm willing to dial in a 3.5 to 4% GDP here, at least for 1 year over the next 4 years. And who knows, maybe it can pretty much average that for the whole 4 years. So I think we've got a better economy coming now. At the same time, the Democrats did not sweep Congress. So there's going to be headwinds. The Democrats aren't going to get everything they want. And that could trim how high the GDP goes. And I realize some people would say they don't care so much about the GDP because if you look at the stock market people, they made a huge sum of money even when the GDP was only 2.5%. But I'm thinking for the average person out there in the middle class, the poor, the small business, commodities, we'd be better off with a higher GDP than that. There was something that was just going wrong, wasn't working right for us. And I think we got an opportunity to do something better in the next 4 years. And I had already been forecasting that before any of this election stuff. But now that it's occurred, I think I want to use that history as additional evidence that we're on the right track here. And the stock market thinks the same thing right at the moment. And I just learned tonight here, I'll probably be talking about tomorrow to my subscribers, that some of the foreign stocks, like over in Europe, Europe has been really nervous about the virus causing a double dip recession. Yet the stock market has been trying to shrug it off. And now the stock market just soared off of this U.S. election. And I think what's going on is they just think maybe we'll all get along a little better around the world. Maybe we can get more trade going. Maybe we can get more business. But even before the election, the global economy was starting to actually turn up by some measurements, such as the PMIs, the monthly PMI indicators for both manufacturing and services. So I think it's working. We want to talk about the virus here in a minute too, but I think global economy, the tide is changing, and that may be also a sign why we've seen some good commodity demand here for these grains around the world. That's pushing prices. That they sense it. That something can improve. They're turning optimistic, as well as trying to make sure they have enough inventory in case another disaster occurs, like the virus gets tremendously worse. They want to make sure they got enough bought ahead and moving there.
Right. Real quick, Rich, I want to jump back and talk about one thing real quick. It just interest rates and inflation a little bit. So we've got a lot of stimulus money floating around, whether it's PPP loans or CFAP or all the other things that are out there floating around. We've got $6 billion worth of stuff that came out. I don't think all that $6 billion got paid out, but talking about doing another round of those things and how that looks. I mean, what's your thoughts on just long-term inflationary? Like you talked about how you're seeing, you're a bear when you start looking at inflation and what that looks like, interest rates, those kind of things. Are you talking like, are we going to see double-digit interest rates, or are we going to see, are we talking like 1980 stuff here, 10 years down the road? I mean, what are your thoughts on that part?
Very good question, because there are people out there that think we're going back to 10% inflation, 20% interest. Some of them are saying, no, not that high, but you're going to be shocked how soon it occurs and how high it will be. And I'm not coming up with that scenario. The way these trends have worked throughout the history of this country, these super cycle trends, they take 15, 25 years. In fact, that's short. And that's what we're doing for a short one. And normally if it's short, you could do it. It's not enough time to really get it high enough. So this is going to be different than what we're used to in prior generations relative to these super cycles. And I just don't think we're going back to that 10 to 20% of kind of stuff there. If it does occur, my guess is it occurs toward the end, which is probably in the 2030s. And that's normally what happens when you have these types of trends that last a couple of decades or more. The highest amount is towards the end, and quite often it's a slow rise for quite some time. Then it starts speeding up, and then pretty soon it just explodes. And then, of course, everybody's got a serious problem. Everybody's complaining. The politicians are getting fired, and everybody's saying, "Kill this inflation, kill these high interest rates," and that's how the process works. So if we are going to those super high rates, I just think that's towards the late 2030s. And so just kind of imagine some kind of curve or slowly turning up, and they'll speed higher as we go into late next decade. Now, along the way, can we have a sudden surge? Yes, and it'll probably just be slapped right back. It'll hurt the economy immediately, and it'll come back. So we can get some surprises here and, big spikes in that. But as I look over the next 4 years, I think the 10-year Treasury note is probably only going to be in the 2 to 3% range at most, and it's still below 1% right now. But it's turning up. I think I called the bottom in August, and I realize it's difficult to call something that's lasted 40 years. But I think I got it, and I'm not the only one doing it. There was a few making a call just ahead of me, actually. So I think even Jeremy Siegel called it in July over at Wharton Business School. And I don't know his track record on the interest rates, but he's done a fantastic job long term in the stock market. So I think we're seeing a major turn here. And the thing is, especially the young people in business and investing and trading, all they know of is interest rates has gone down their entire lives. So it's going to be a new ball game for them. And some of the old timers, even myself, I sat back thinking, gee, what was it like in the 1980s? We were coming off the highs, but so there's going to be a learning curve for everyone how to handle and deal with this over the next 10, 20 years. But generally, in the early part of an inflation swing and a rising interest rate swing, it's actually a good economic time. And commodities do better, and the middle class and poor do better. So, yeah, in the next couple of years, I can see where we move up to 2% interest, and I wouldn't be surprised the Federal Reserve will finally get the inflation above 2%. And I think they probably will be very cautious of reacting to that quickly. So I wouldn't be surprised we could even see 3% sometime in the next 4 years. But are we going to see 5%? I think that's further down the road. But again, maybe something I don't understand. You're going to have some little shock there that suddenly puts it up, but it'll just put it right back down and then still follow that slower uptrend. So I don't necessarily see a panic out here, but I do think anyone who's never has their interest rates locked in, I don't know. I think you're living on borrowed time.
Right. Yeah. No, I agree.
And the reason is that, that $6 trillion or whatever they pumped out. I mean, the thing is, we've been printing money, and then suddenly it was just a gigantic surge. And you just see a lot of Wall Streeters, bankers just saying, you know what, that's unbelievable. And
right.
It is changing the attitude, So it's a good thing, but I realize people, it's not a good thing for everyone. But I think it's I like what I see. I think it's going to be a positive thing with the overall economy, and I think that's how you get a 4% GDP. Is you're going to have to pay a little more on the interest rate, and you're going to have to pay a little more on cost because of higher inflation. But you know what? You charge more for your service and your goods, your commodities, and it just seems to trickle around the system better. And I just feel like the middle class and poor can do better this time around, So if you're a rich person, yeah, you probably better own some gold.
Right. Yeah. Okay, so let's talk about some foreign markets right now, and you kind of hit on the coronavirus and what we see happening there, and Europe has gone back into a shutdown mode. I don't know I haven't really seen how long they're projecting, but they 4 to 6 weeks is what they've kind of started out with. But that who knows what that'll turn into as things continue down the same path. The name escapes me, but Biden's advisor on these kind of matters is suggesting a 4 to 6 week shutdown in the U.S. I guess as you take a look at these shutdowns and kind of what happened last time during these shutdowns around the world in the various economies that are out there. I mean, what are your thoughts about if we go back and do some level of a shutdown somewhere in the U.S.? I mean, it feels like we've made some pretty good momentum in the markets, like you talked about, and some longer term things that you see happening there. I mean, do you foresee anything like that happening? And then, are we going to get back to that $3 corn, $7 beans, those kind of things again? I mean, I guess what's your thoughts on that scenario?
Yeah, I kind of hope they don't do the lockdown. Other than, yes, I think it would work to help kill this whole virus thing, and then we'd be all right later. But there's a lot of discussion that wherever there was lockdowns throughout the world, it's been quite a while, and I've had some data saying, it didn't really help that much. And some of the big U.S. banks come out saying, this doesn't look so good, Not so sure you want to try that. And I think the World Health Organization, even though I'm not too sure they did a good job keeping up with this whole virus thing, so maybe we should question any opinion they have, but they even come out saying, doesn't look like a lockdown approach works. I would prefer much more of pushing the mask and the social distancing and get mean if you got to do it, because I'm very convinced that would make a big difference. I've been trying to keep up with the research on that, and our daughter's over in Asia, and she's dealt with the mask over there, and she's just saying, Dad, these people have been way ahead of us by decades. They just know how to do it, and it's working over here, and their economy's doing well now. In South Korea, my daughter's over there right at the moment, and she just says they're getting happy here. It's looking good. And yeah, they've had some setbacks at times with the virus, but boy, there's some countries out there. I can't remember if it's Taiwan or one of the smaller countries, and they haven't had a case in like 200 days, I think I read, or something like that. And it's there, it's present, but it's just not getting to them. And it's just how their lifestyle, how they're living and dealing with and working. So I'd rather try that personally, because even though it's only 4 to 6 weeks, I mean, my gosh, another lockdown, you're going to print more money, and even that money trickling through, it doesn't help everyone for the full extent of it. So it's like, you're going to hit the economy, you're going to hurt business. Will it slam corn and soybeans back to $3 to $7 respectively? Not off a 4 or 6 week thing. I think commodities will take the attitude. People are still going to eat one way or the other, and but at the same time, looking at these prices today, it would help. I'm looking for a dip here by next month, by the way, and for some of these commodities, and I just. Boy, the faster we rush that in there to get into that 4 to 6, it's got to cause some hesitation, some problems here in the commodities. But it would probably be more of a stock market hit, which I'm also looking for a little setback in the stock market before we get rolling here on the bull market again. So it could occur. That may be why I'm seeing some of these things that could set back. But my guess is the 4 to 6 thing. The longer it takes Trump to transition, the more likely that won't be done after the first year anyways. Right. And that would be a different scenario than what I'm looking for this dip into December.
So what's the dip? What's going to cause the dip?
It's basically just saying that many of these commodities, it's just time for the available demand side to back away, that they bought enough and they ought to take a little break. And at first I was nervous it might have something to do with elections transition, not so much anymore. If that's something goes wrong here with transitioning from Trump to Biden and the election, I think that's more of a stock market thing. So to me, in the commodities, I think it really is the true business of commodities that the buyer just temporarily needs to say, I'm not going to bid even a penny higher. And it won't matter that the supply side is saying, well, I'm not going to sell it to you anyways. I want the higher price. At least in the futures market, somebody will always come in and sell it and bring it down. So it's how we do business normally during the year on the commodity side. But I'm just saying, if one of those dips is due, and there'll be another one sometime early next year.
Right.
If one of those dips are due at the same time you bring in that 4 to 6 week, well, that could help explain it too. It could add more downside. But no, I don't see something that suddenly just backfires here and really hurts the economy. I think if there was something that caused a huge disruption like that, knock soybeans back to $7 in the next 6 months or something, you're going to see the stock market way off. It would have to be maybe the virus is just way worse than what any of us can fathom right now, and then you probably you can't help but have a panic and shut down the economy. There should be a level where even I would say, shut that thing down. Everybody stay home. Right. But I'm not convinced. This is the time to do it. I wish they really would try the mask. I know a lot of people will never believe the mask, but I just saw a recent video of someone studying it, showing what was coming out of the person's mouth, and it made a huge difference. And I think we could just do a lot that way to clip this. Now, in terms of my forecast on virus, I must say I've been very pleased with my modeling this year in the commodities and the stock market. It's just one thing after another is working great. So I tried in June to say, I'm going to dive into this virus thing. And granted, I'm not a medical person and I'm not going to have the data, what's going on every day. But I said, if I can just take the end-of-day cases, can I find patterns like I do often in prices and various economic data? Because after all, it's really about people. It's not the virus creating those fluctuations, it's about people. They get excited, they go out, they do things, next sick, they're running to the doctor. That scares everybody else, so they stay home. Pretty soon the cases are back down. And pretty soon everybody's running back out to have some fun or go shopping or obviously do your job. And so I said, seems like this should work. Well, lo and behold, I did some modeling, came up with a pattern, and it's nowhere near the deep economics and markets or anything like that. We would need years of history to really give a beautiful story to it and really make it work. But at any rate, I could see from June through August, I said, this darn thing is learning it. It's catching up with it. It's making good forecasts, and and then finally, coming into Labor Day, it made a forecast for a major turnaround and said, maybe it won't go to a record high of cases, but we should see cases rising from around Labor Day to the week of November 20th to the week of December 18th. And that's currently the forecast. And here we've surged to record high now. Okay. And I did some funny little things on the way up and said, what if I could even forecast the next level? And it was interesting, just a few days ago, he said, well, we're due for 123,000 to 135,000. And man, it popped to right about 123, sat there, and then popped right up to 135, and then actually pulled back. And I said, well, that's working pretty good. Well, now it's already gone through it sooner than I would have thought. And I got a feeling we're on our way to 160,000 cases. And there's health officials out there saying we may well see 200,000 this winter, and I wouldn't rule that out either, but I'm going 160 is the next level or so. So even that little idea is working, but that's even more experimental. I don't know if I should be trying to look like a genius and pick actual numbers.
Right.
But I'm very comfortable with this trend, and we'll see what happens. Maybe it will end here in just another couple weeks. I do think Thanksgiving will actually cause the cases to come down some, but it could easily cause it to be right back up after the holiday. And I am concerned of something more important for a bottom in December that could mean still greater number of cases in January, February, March. And I don't really want to see that. I think that's going to be late enough. You're going to start scaring some business people and investors here. So even though I'm kind of gung-ho bulled up here on practically everything for the next 4 years, I can see how something can go wrong here in the next 6 months or something. But I don't see it that major decline like soybeans crashed to $7 or anything like that. But the cases can get worse here on this virus, and the deaths are picking up, even though you can see the difference between the cases and the deaths. You can see we're definitely doing a better job at the hospital level of handling it, dealing with it. But now we've got the issue of the hospitals are full, they're running into that issue. So I think this is what can partially cause this dip I'm looking for in the stock market in the next few weeks here of worries over these cases, where the virus is going, because I'm not convinced anybody's going to do anything about it until after the first year, just because of the political situation and how the process normally works. Maybe somebody can put something in there faster. And I'm concerned the government really is going to do anything about stimulus and helping people who are losing jobs, need money. That's going to wait after the first year. So I could see more downside in the stock market than the commodities. But it is interesting that the strange thing is I got the bonds perhaps ticking up a bit in December. And I got the dollar perhaps ticking up a little in December. And that could be a reason of risk off, meaning they're worried over things, they're concerned of things. And at the same time, I'm saying, well, the commodities ought to be down a little bit. The stock market ought to be down. Maybe that is all lining up, that we've got issues coming by December here, that maybe this virus is going to get far more serious, and maybe we're going to have some political issues yet here. And of course, we haven't seen the electoral college vote until December 18th,
right.
I think.
Yep.
So there's definitely some twists and turns. There's always twists and turns you got to deal with, and nothing moves in a straight line. But like I say, I still feel like when I forecast 1 to 4 years out, it says we will get through the virus and we will have a good economy and we'll have better commodities and this and that. But there could definitely be periods here of downdrafts and some discouraging news at times too.
Right.
So,
yeah. The one thing about the virus, the virus rate of compared to the contagion rate compared to the death rate, it's not growing up as fast as it was when it first came out, in February and March, correct?
Correct.
So
you could see a difference between the recoveries. You could see the medical people are doing, the doctors and nurses.
Yeah,
they're doing the best job.
And we know a lot more about it now than we did in February.
That's right.
That's right. We have a lot more
but
information.
Now, what probably would be the next worry, though, is can they handle it if they just get swamped? What kind of issues that
exactly.
But the same thing with the deaths too. You can just see we're not losing as many people as the pace of increase in deaths, which it's increasing, but the pace is increasing slower than the pace of the increase of the cases of the virus.
Yeah, it's a crazy thing, man. There's so many. It's such a dividing line as far as how people react to that.
No.
It's totally
I totally get why people are saying, "Hey, I've been through sicknesses before, and how can this little mask do something?" And I get it. It's difficult, and that's why some of the government people are saying. That's probably why they're saying let's have the lockdown, because they're just saying we don't really want to fight with people to tell them you are going to do this, or we're going to fine you, or throw you in jail, whatever. They're just saying, heck, we'll just lock down the economy. But problem is that hits your whole country. So
right. Yeah.
we're all going to take a hit from that, right? And so, and again, I don't think it'll be an end of world scenario, especially if it's only 4 to 6 weeks. But it is something to wonder about,
Yeah.
I'm just saying I'm not so sure I would try that direction, frankly. But on the other hand, where are we tonight? 140,000 cases per day. Boy, you start hitting 200,000 cases a day. I don't know. There's got to be a level where even I would say, boy, shut this darn country down. Tell everybody to stay home.
Yeah. Well, yeah, I think so too. But it would have to be the fear is, the hospitals getting overran and what that does, and then the fear that inflicts, and how that overwhelming fear relates back to stock markets and those kind of things, and then has that plunging you into a recession. Then you go ahead and shut it down for 4 to 6 weeks, and people are still scared of what's going on, and then what the uncertainty on the backside comes out. Because we tried it once already, and we saw what happened, and then now we're coming back into it again. And I think that's the biggest drawback. I don't know that many people would actually go through with it, to be honest with you. I mean, they can fine you and do whatever they want, but I struggle with that part a little bit. As to what the reaction would be from the populace, especially in some of these, especially some of these towns that are out there right now. But like you said, I mean, the explosion of the virus in rural America is it's just there's just hot spots, and they just kind of flare up, and then they kind of go away after a while. Then they might flare back up again, but it definitely is something to definitely keep your eye on, because if they decide to do something with the economy, I'm not optimistic as you are. I think it would be. I think it'd be more damage than we could see.
Well, let's face it. Look how quickly the economy fell down.
But there was a lot of fear involved that too. People didn't know how long that was actually going to last. And again, we know a lot more about coronavirus in November 2020 than we did in February of 2020. So, but
I know. And
I was convinced that we were never going to get out. Like, they were shutting everything down, and we were going to live in your house, and you're going to have to like duct tape your door shut so you didn't have to get anything come in. It was just that was kind of the level of fear that was out there at the time, and now we know so much more about it, and I don't know. There's just a million things out there right now that are going in good directions, and I know we got to control things, but at the same time, these small businesses, I don't know they can take another 4 to 6 weeks of shutdown.
Well, that's a very good point, and that's what I'm concerned is they really can't. I shouldn't say they can't print enough money. It's really probably more of a case they can't get it out there fast enough to really use it. And that's what the Federal Reserve is planning on for the future. Is they know they got to come up with something better. So I will not rule out a double-dip recession. I'm optimistic looking out over the next 4 years. My model is saying, we ought to have a recession by no later in 2020, but it also said, it doesn't have to end to 2021, the latest.
Right.
And yes, we've seen really a very nice recovery. But what if something just slammed everything back down again?
Yeah.
I'll just start over and be optimistic again. But the point is, it could be, you're right, it could really backfire, right?
Yeah.
It could be devastating. So,
I mean, that's the thing, too, when the whole stimulus packages and stuff that came out. I mean, some of these businesses got a $1,200 check to keep their doors open and pay their. I mean, I know the PPP loans and those kind of things, but that's been a mess. I mean, between the fraud and they change the rules every week to something different, and there's a new nuance that comes in there, so no one really knows if they're in compliance or not, and they did everything they thought they did, but now there's a new threat, and there's just all kinds of stuff out there. But some of these small towns, like where I'm at, out here in Scottsbluff, I mean, there's not that many little restaurants and bars and those kind of things. It's not a vibrant area, and one of these little small town cafes shut down because of this. That's a big impact on the community, these little things kind of pop up, but it'll be just like you said, it's going to be interesting to see what happens, how it shakes out, and what happens. But at the end of the day, I'm not a believer that shutting the economy down is going to. It's just going to create a whole new problem on the backside that. You cured a short-term deal, and you got a long-term problem now on the backside.
Yeah, that's exactly why I wouldn't try to go that direction myself. I'd like to just try to work other ways to get it done because if you lock it down, it's a very simple equation. You know what's going to.
Yeah.
The only debate is how severe is it?
Right. Yep. That's exactly right. Rich. Well, we've covered a lot here. Is there any last thoughts you want to throw out there before we close this podcast down?
No, like I say, really, yes, we got to deal with the virus, and we may be dealing with it for quite some time yet still. And yes, we got the political things still yet to work through and get into the start of next year. But as I look farther out, I'm still optimistic and bullish here, and done very well here in these markets. And I think there's more money to be made in the stock market here. And this new service I got, it's going to tap into something where I've made something like nearly 700% in 10 years or something like that. And I'm going to show them exactly what I'm doing. And they don't necessarily have to follow that because there's many different investment products they could use as alternatives. But I'm just going to show them that example. More importantly, I'm going to give them the signal so they can know, hey, when do I buy a little bit more from my retirement account, or when should I kind of hesitate just a little bit? And then ultimately, later this decade, believe it or not, we're going to be back to another recession, hopefully not a virus one. And hopefully we'll really show the value of it, of where we can protect ourselves by getting out of the market, because it certainly has worked good for me for about 2 decades now. And this is actually the 3rd decade that I've been using this technique, and I've been keeping track record for about 10 years. And so I'm pretty optimistic with it. And I didn't throw in that, again, got to get through this virus, got to get the global economy growing and whatnot. But on commodities, if you look at commodity index like the Goldman Sachs commodity index, I think they put in a minor super cycle bottom. I think it can have some kind of floor price for several years, and that means some kind of a bull market coming. And I've already made a projection of at least a 10% to 20% rise that could occur next year. And the only way I see that not working, actually, is, we do have a mess up here with the virus and maybe a lockdown, and we do get a double-dip recession. Well, then that 20% up move in the commodities is going to be shoved out for another year, right?
Right.
So again, there's always, you never get everything 100% the way you want it, so that you don't have any problem. Always twists and turns the market. But anyways, I'm optimistic on commodities next year and the next couple of years. And it looks like to me the only reason I point out the commodity index is it's a basket of commodities. So if you can be bullish that, you got to start looking around, and that means more than one commodity is probably going up. So be interesting to see. Yeah,
it will be. Definitely be a fun ride no matter what happens, right?
That's right.
That's right. Good deal. Well, Rich, tell everybody where you can go find your podcast and subscribe to your service.
Yeah, so you can go to criticalpoint.podbean.com, and you'll see a list of free videos, audios, as well as buy button for a service that's just charges monthly recurring, and that's what I call the combo service now, that it's commodities and the stock market, economy, climate, anything and everything I can throw in there. And some of it gets very detailed. I'll discuss everything from short-term to long-term. So I have a variety of people using it for all types of reasons, and we're very pleased with it. And now we're adding this new one that I don't know if you'll find it directly off of that criticalpoint.podbean.com site, but I think if you did a search, you would. And it's only going to be available on the Podbean app. Their app now has like 2 million viewers, and they really want to push it. And they set up these new channels that you pay for. They didn't have it in the past, and I decided to set it up there. It's more secure and just inside their app. And that one's a cheaper service because it is just long-term and it does not do the commodities. It's strictly the stock market and a little bit on economy. But it would help. I'm going to try to help beginners. I've already put up some educational pieces to show people this is how you can enter an order, buy, sell, or if you're using a financial planner, this is what you can talk to them about, how you want to try something or follow a signal. And then, of course, I do the little bit of education on the model and then give the signals and analysis. So we're getting that underway this week as well here. And so I'm pretty optimistic being able to help the long-term people as well as those who are more active in the markets. So.
Yeah. Well, I'll probably...
let me give you the Twitter, my Twitter account. People might want to, you can either direct message me over it or maybe want to get on some chat of what's going on in the world. But it's at Rich_Posson, Posson. You can also email me at rich@ag-financial.com and if you have a question or comment. So
yeah, check out Rich's Twitter. There's lots of good stuff out there, and I'm going to subscribe to your service so I can get that 95% return that you got on talked about earlier. Nah, good stuff, Rich. Glad to have you back on the podcast, man. I am Casey Seymour with Moving Iron Podcast. Make sure you check me out on Facebook, Twitter, and Instagram. That's where you're going to find the latest editions of the Moving Iron Podcast and blogs that I post as well. Also, check out movingironllc.com for all the latest information on the Moving Iron Summit. That's Nashville, Tennessee, January 20th through the 22nd. And there'll be some great speakers there talking about some of the stuff we just talked about here. And so if you're interested in that, check that out. You can register for the event there, and also you can send me an email at movingironpodcast at movingironpodcast.com. Also check out Global Ag Network. A lot of great podcasters out there, like the Dryline Farmer podcast there with Brent and Landon. Those guys are a hoot. You'll have a good time enjoying what they have to say. So with that, I am Casey Seymour with Rich Posson. Let's move some iron, folks. Out.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving